And now this is chapter 12, the last chapter of this semester. And we're going to actually focus on only one thing, the time value of money. But there are some other not so important compared to the time value of money. And we're also going to cover that. So we have 4 objectives. The first one is to describe the importance of capital investment and capital budgeting processes. In this objective, we wanted to know what is capital investment. So a capital budgeting or capital investment here is acquisition of assets used for a long period of time, which require a large sum of money. Usually, capital investment is big money to be paid, and it goes over a long period of time. So there are 4 methods. We're going to go through each one, and our focus will be on the net present value and a little bit on the IRR, internal rate of return. And the first 2, we just simply go thumb through and just introduce some concepts, and then we're going to go on to focus on the net present value method. We have learned in financial accounting the cash basis and accrued basis in accounting. So accrued basis is required by the GAAP, and capital budgeting focus on the cash flow, and we're going to use accrued basis based accounting income. So the cash flow we're looking at is a future cash flow, and so because it's budgeting, we're looking at the future, what happens in the future. So it's all about future cash revenue, future savings and ongoing cash operating costs, at the future residual value of the assets. So these are the steps, comes from the book. So I'm not going to get into this one, and it's basically we're going to look at a formula to see how we can do a calculation. So in 2012, 244 billion were invested in clean energy, so sustainability. This is a little bit of old data. Again, every chapter in this book talks about sustainability, and just read through this, just get some idea. So we're going to look at how we are going to do the payback and accounting rate of return methods to make capital investment decisions. So payback period equals to amount invested divided by expected annual cash inflow, net cash inflow. So we are looking at how fast the investment will get paid back. So we're going to use how much the amount we have invested, total say $100 million, and whatever you invest, you're expecting some returns, and you're going to see, okay, it's going to generate some cash inflow every year, and then you're going to see up to how many years all the investments will be covered. So this is an example here. Just very quick. We're going to go through this. The firm is considering invest $240,000 in hardware and software to develop a business-to-business portal. It's a website. The company expects the portal to save $80,000 each year. So we're going to use the amount we invest divided by the cash inflow we generate. So it will take 3 years to get paid back, and this is going to go on for 6 years. Means, okay, after the first 3 years, we're going to start making money. So this is a good investment. So this is basically we're going to look at how many years we're going to get money back, and after that we're going to start to get payments, and that will be our revenue. So it uses some the book uses some examples, and actually this is an example. It's in the exercise and after the book chapter, and so here is kind of unequal net cash inflows. So where's my mouse? And this is every year we're going to get a different amount of money in. So you're not going to get a even number, or sorry, the integer on the number of years to get payback. So there'll be some decimal points here. So this is a $240,000 investment, but we're going to get a different amount every year. So after the third year, we're going to get up to $230,000, but it's still $10,000. So, but in the next year, we're going to have a $50,000 return in cash inflow. So $10,000 of this is going to get to here to reach 240. So as it says here, so we're going to use 10 divided by $50,000 would be 0.2. So it'll be basically 0.2 year. In the third year, fourth year, we're going to get everything paid back. So that means we're going to have 3 plus 0.2, 3.2 years. So this is how it's been calculated. So this is in a book, and we're going to do the readings. It's pretty easy. And I'm not going to do this one, but it's listed here. If you're interested, just look at it, payback here. Another method is called accounting rate of return. The formula here depends on what data we have. So if we have annual print income from assets, then we divide by the initial investment, we're going to get accounting rate of return. Or we can use, this is more commonly used, average annual net cash flow minus average annual depreciation expense. So it'll be accumulated depreciation. Not really accumulated, but for the year, it's not accumulated depreciation. It'll be depreciation of that year minus the initial investment. So it's going to give us that amount. And for the previous one, and it's 240,000, and it goes all 4 years. Depreciation with 40, and then we're going to use $60,000 cash inflow minus $40,000 depreciation. It's going to consider as outflow, the cost, and so we're going to get an annual rate of return. Accounting rate of return will be, I'll use this number here, is 8.33. So this will be the return. And there'll also be unequal cash inflow example is in here. It's pretty simple again. I'm going to take a look again. 1, 2, 3 after this year. We're going to get to $240,000, but here we're not getting an even number, so we're going to use the average. So average cash flow will be total of this 360 divided by 6 periods. So each year we're going to have an average cash flow of 60,000, and so depreciation will be 240 divided by 30,000 minus 30. Oh, this is a residual value. If you remember my financial accounting, this is the cost minus the residual value divided by years. It's a depreciation every year, a straight line, and then I'm going to use this formula to find, okay, our accounting rate of return is 10.42. So that's good. It's the bigger the number it is, the better we are. So this is the second method. So I'm going to actually, the focus here is the a present value and a future value, the concept of that. You're going to learn this in your finance 3220 class, business finance, and you're going to be focusing on how to compute the present value and future values, and how to find the relationship. And there are pretty good number of formulas you need to remember. I recommend that you go to YouTube, put in the present value or net present value. You're going to see some very simple, well explained video, and see to try to understand what this means. The basic idea here is the money today does not equal to the money tomorrow. Why? Yeah, probably one day is too short. So Monday on January the 1st will be $100 on Monday on January the 1st will worth more than the $100 on December 31st. Why? That's 1 year difference. So the value of the money changes, and the time plays the role in here. So we say, okay, there's a time value of money. So we're going to see how we can calculate that. The major reason here is money can be invested and earn income over time. So let's assume, make it easy, $100 you have invested into some business and you're expecting to get a return of 10%, means the interest of 10%. So $100 after a year, how much do you have? You need to use $100 plus the interest of 10%. So 100 times 10% is $10. So to the end of the year, the $100 will be $110. So I can see the present value of $100 equals to the future value of $110. So you see the value of the money has been changing over time because money will generate money or interest because of the time. So that's the main idea of the time value of money. And then we're going to look at how do we calculate or find a relationship between present value and a future value. Okay, so the basic idea here is let me see if I can put in here. Use a pen. So future value equals to present value times 1 plus I to the power of n. Okay, so let me explain this. This is not in the book, but you're going to see when you do the search, you're going to see this fairly easily. You're going to see this formula, and from this formula you can also find out what present value is. Present value equals to future value divided by 1 plus I to the power of n. So I can put it here. Present value equals to future value. This is not going to be in the exam, but it will be a very good way to understand Okay, so this is not another. They are basically two same thing, same formula, but you're going to focus on what we're going to calculate. So if we have say $10, right? The $10 now $100 we have. So after the first year, if the 10% is the interest rate, so 1 plus 10% is 1.1 to the power of 1 year. So 1.1 times 100 is $110. So the future value of $100, if the interest rate is 10%, and then we can get $110 with the present value of 100. Same thing we'll do here if we know the future value and also the interest rate and the period, we can find the present value. And we're going to look at the net present value, and so that's for the annuity. We're going to look at it later. And so basically that's the idea of the time value of money. And I try to understand this, and if you understand what we mean of the present value, we mean about the future value, and the rest of the chapter will be a piece of cake. Very easy. So when we talk about the time value of money, we're going to see how much money do you have. A single lump sum and annuity. Annuities will be payment of every year, annuity every year. So so a lump sum, for example, you go to the lotteries and you're lucky, you win $50,000 or $5 million, whatever number. And if you take the lump sum, it'd be $5 million, and that's called a lump sum. You take all. Or you can get an annuity, and so you could say, okay, this is $500,000 will be paid to me within next 20 days or 20 years or 10 years. And why do we do this? Because if you want to receive a simple lump sum, you're going to pay tax on it. So $500,000, you need to pay about 50% of the tax or even more. So you're not going to get that much of money to your in your pocket. Or you can use annuity. Annuity is every year you're going to actually get more money back. You're going to get pay tax anyway. So you're not going to save, but it's going to help you to plan. So you're not going to get a lump sum money and then spend it all the way out. And so then a few years later, you feel, oh, I don't have a penny in my pocket anymore. Or you can have annuity, and that the payment will get to you within next 20 years or 30 years. And so it'll be kind of a fixed income every year, and it's going to help you to plan your money. So the idea here is if you use annuity and use a lump sum, and the present value is always the same because you only win this amount of money. This is a present value, and so that's basic idea here. And so number of periods, so 10 years, 20 years, 30 years, and whatever, and interest rate. And so if you're going to invest, you're going to get interest rate 20%, not 20%, 2%, 3%, or 5%, 6, 7, 8, 10%, whatever percent you can get. So you're going to use this interest rate to calculate the present value, or you can use that to calculate future value. Okay. And here is simple interest. Or simple interest means interest calculated only on the principal amount. So you have borrowed, or you invest, whatever. Let's say you borrowed $10,000, and you're going to return that in 10 years. And that's investment. It's easier. Let's okay, investment $10,000, and you're going to get all your money back, $10,000 back in the 6th year after 5 years. So your interest rate will be 10%. The interest rate is always annual. It's every year, so 10%. So that means you're going to, if it's a simple interest calculation, so you're going to have 6% all the time, and your principal always $10,000. So 666 and a total of $30,000 you're going to have from this 6% interest. So to the 6th year, you're going to get $13,000 from the investment, $10,000. Okay, but more practical we're using is this one, the compound interest calculation. And compound means, okay, you're going to earn interest on the interest you earn. So for example here, after first year, you earn $600 based on 6% all the time, and then 6% will be added back to your principal. You're going to earn interest on this $10,600 at a percent of 6%. So it'll be $636 in the second year, and you're going to go on after 6th year, and you're going to after 5th year. In the 6th year, you're going to earn $3,383. Remember, last year with a simple interest, you earn only $3,000. Now you earn $383 more because of compounding. Compounding is a very, very powerful tool for the banks or for the investors, because it's going to generate a lot more money. And if you have, say, this is 10,000. If you have 100,000, suddenly you get a compounding interest of $3,830. And here actually, if you go on little more years, and this grows a lot faster because you're getting a bigger and a bigger principal to calculate, and your interest is going to be bigger and bigger. So this number grows a lot faster. Okay, so this is kind of a the example of the difference, the relationship between the present value and the future value. So present value plus interest earned is the future value. So $10,000 plus interest you have earned is the future value. And so I'm not going to go through this table thing because in the real life, probably it'll be more convenient to use a formula that I have given to you to find a future value or find a present value using a formula. So I'm not going to use the examples here because it uses a factor to do the calculation. And the next one is going to talk about cash flow models to make capital and investment decisions. So we're going to first we recognize the time value of money. The money does not stay static; it changes value throughout time. And there are two methods: net present value and internal rate of return. This is only a transcurrent introduction, and we're not going to get through this very extensively because you're going to learn this more in the future accounting and finance classes. Net present value is called a discount rate, and the hurdle rate requires rate of return, mostly called the required rate of return. Required minimum rate of return given riskiness of the investment. Proposal is acceptable when a net present value is greater or equal to 0. Means okay, if you want to do an investment, and so $10,000. The worst thing we can accept is that we're not going to we're going to earn the interest. It's going to generate the net present value that is greater than or equal to 0. You're not going to lose money on it because, say, there is a depreciation, not depreciation, the money, let's see, inflation. Yeah, I just forgot the name. It is inflation. Inflation means things getting more and more expensive, and the $100 can buy $100 worth of things now. You'll not be able to buy the same thing in the future because the price goes up, and so it seems to be that $100 is getting less and less valuable. So what we want to do here is if you want to do an investment, and we're going to make sure that we can discount back to today's date, so that we're still getting the total return on the investment that's greater or equal to 0. So, and here's a kind of way to calculate. Net present value method here is the present value of annuity of n equals to 5. Annuity, its interest rate is 14%. It's very high actually. You don't see this very often, and it uses something called annuity present value factor. It's in the table, so don't worry about this one. I just assume it's given, so you can always find this one. You can go to the annuity present value table to find this factor, and you can use the factor times net cash flow, annual net cash flow, and it can get a present value of the whatever annuity you have. So if your initial investment is $1 million, but here you get $1 million. You got $48,000 more, $40,600 more, and the net present value is $48,600. So just try to understand, read the book chapter, try to understand what net present value is and how do we judge on our investment. Basic idea is the net present value should be greater or equal to 0, and the investment will be acceptable, and otherwise we're not going to do that because you're losing money on your investment. So here's the decision tree. So if the net present value is positive with an investment, and it's not, we do not invest. So there's some examples. So I'm not going to go through this. You can do some readings fairly easily. And I just want to make you be aware that we're going to don't worry about these ones, and we're going to jump through. And our exam on this chapter will be on the present value, so, and the net present value, and I try to focus on that part, and you'll be able to do the exam. But we do have homework that covers most of the other ones. And so here's the internal rate of return. Internal rate of return is here, and the interest rate that will cause the present value to equal to 0. And so what is that interest rate? That interest rate is the rate of return. So the internal rate of return. So let's read the first one. Rate of return a company can expect to earn by investing in the project. So the worst scenario is earn nothing. And the best scenario, of course, the most we can earn. So what is the minimum rate? The interest rate is acceptable so that we make this investment is called internal rate of return. And finding the discount rate that makes the cost of the investment equal to the present value of the investment's net cash flow. So it's pretty much the same as the NPV kind of method. And so annuity factor equals to investment divided by annual net cash flow. So this is basically it's what we have done in the net present value one. So not going to look at the examples; they are all from the book. You don't worry the chapter this one here, object number 5. We're not going to do very much in this one here. And so basically this chapter is more on the net present value, and we're not going to do very extensively on this in this chapter. And you're going to basically do a very simple calculation and find out how what net present value is, or what present value is, and what is time value of money. With some background knowledge of this, and it'll be easier for you to do your future study when you move on to in a business major. Okay, so thank you very much. This will be this is a short chapter, and we're going to be very focused on some concepts on the present value of okay, let's see, on the cash should be the time value of money. Oh, it's just got out of my mind. Time value of money. So that's our focus. All right. So thank you very much. And we had a very quick, very fast semester. And hope you enjoy the class. And your grade will be posted next week, probably by Tuesday. And you should see your grade over there. Okay. If you have any problems, any questions, any concerns, so please text me or email me, and I'll be available to answer your questions as soon as possible. Thank you very much, and have a great rest of the week. And see you probably if you take my class, Accounting 4160. It's the computers accounting for the accounting majors, and I will see you then. Thank you. Bye.